Hello everybody and welcome to the first SFI Not So Live of 2022. You'll be listening to this in February 22. Just a little caveat, if you are listening to this in the future, some of the things we discussed today might no longer be relevant. So bearing in mind this was recorded in February 22. Welcome. So to those of you who joined us before, SFI Not So Live is all about talking about the mortgage and property industries. I'm joined by a variety of different guests every month, but there are some stalwarts in the likes of Mr. Tony Hall. Tony, say hello.
Hello.
As people know, Tony, just give an introduction to who you are and what you do.
Yeah, hi. Sorry, I'm flipping there. It's Friday and no coffee. Yeah, my name's Tony Hall. I'm head of mortgage sales here at Saffron. So focused on supporting our intermediaries and their clients to get the homes of their dreams.
Love that. Home to the dreams, always a good phrase. And Phil's back with us again. Phil, you haven't been on since last year. So, well, none of us have been on since last year. We were early last year. Phil, welcome back. Do you want to do an introduction of who you are and what you do?
Yeah, thanks, Jay. I'm Phil Lawford, Business Development Manager for Saffron, covering the North and London. Just helping intermediaries find solutions for their more complex, nuanced applications.
Couldn't put it better myself. And finally, our special guest for February is Mr. Greg Cunnington. Greg, welcome to the panel. It's your first time with us. Why don't you give the audience a little introduction of who you are, who you work for, and what you do?
Morning, thanks Jay. Hi everyone. So I'm Greg Cunnington. I'm Director of Lender Relationships and New Homes at Alexander Hall. We're a mortgage brokerage, been around for 25 plus years. I've been with the firm for 15 years. We're part of Foxtons Group PLC, so geographically most of our business is predominantly in London and the South East. I head up everything lender related, which involves various different hats, but I suppose my favourite hat is the one that means I have various meetings with the likes of Tony and Phil to discuss criteria, propositions, and how that can fit in with our client base to help them get their dream homes, exactly as Tony has said.
Brilliant. Thanks, Greg, and welcome. So, just for the sake of listeners, if you are a new listener, just to give you a bit of background in what SFI Not So Live is all about. We are here to talk about things that are happening in the mortgage and property industries. We've trawled the news, we've found recent news or opinion articles, and we're going to give our opinion, or certainly the guys are. So we're going to trawl through a few stories this morning, go through them, and we're welcoming your feedback. You can listen to us on a variety of different channels. So if you haven't heard of the previous ones before, have a look at the previous episodes. We do talk about a variety of different subjects. But first, I want to come to the panel. It is 2022. The 2021 that was has left us. It felt like it was a very long year. But there were some ups and downs. I mean, it wasn't, the best year for everybody, but certainly the market remained buoyant. It was lively. Things changed. Certainly things changed with certainly the lenders as well. I think, you've seen products come and go. More come than go, from what I can tell. Tony, just coming to you. What was your highlight of 2021? What do you think was the biggest surprise, maybe, or something that really stands out for you?
I just think the the highlight for me in a pandemic of concern and worry that the housing market had one of its best years ever. And whether that was fueled largely by the stamp duty holiday and the end of that and that drive, but there's been no sign of it slowing down as a result. So I think in a very tough economic environment, the housing sector has stayed extremely strong and has welcomed probably hundreds, if not thousands, of new people to the industry. Because I'm sure Greg can give us more context on that, but recruitment for advisors has been strong to meet demand, so that's been growing. To the latter part of the year, I think it's driven BDM and business development recruitment for lenders, so that's great. So I think out of a dreadful situation, we've seen a really positive 12 months. And another positive 12 months to come. A slightly different lens focus this year and how the market is changing, but it's still positive and it's all still about growth. So I think that's probably the biggest thing for me out of all the misery. It's been really good for a lot of people.
Fair. Phil, I'm going to come to you first. Greg, I'm going to come to you because I know Tony just queued you up a little bit there. But Phil, I'll just come to you quickly. What was your highlight of 2021?
Yeah, the best bit on a personal level was being able to see people again, face to face interaction, going to some industry events, seeing that they're back on. That's some of the expos and some of the network and distributor road shows. So that was fantastic. Just seeing old friends face to face again was great, and meeting new people as well. And yeah, I think it also sort of reflecting and supporting what Tony says. Just how as an industry we responded to the pandemic. I think this time, or the end of 2020, we thought it was pretty much all over. Then we had the second wave, and we did it all again, and we all collaborated. We responded well with payment holidays. Lenders enhanced the criteria to reflect the changes. We did that ourselves as well. And we all kept trading, we all stayed in business, whether that was doing things virtually or and then face to face as well later. So it was. I think we're probably stronger as an industry, more adaptable and flexible than we were ever before. And for me, those are the positives.
Amazing stuff. Greg, coming to you. Obviously, we've got a bit of a siloed impression because we're going from Saffron's perspective. From yours as a broker, what was your highlight of 2021, and how did you see the market change during 2021, and what will that mean even for 2022?
Yeah, and how the market change actually ties in with some of the positives, I think, because I mean, first of all, it was just a really successful year for the industry, wasn't it? Which I think is amazing if we go back 12 months. So we've seen the stats from IMLA on gross lending. Our lending was the highest since 2007 as a business, which I'm sure is a similar story for almost everybody listening. And I think part of you think how busy that was, and we're in a new environment of kind of hybrid working or full-on remote working. And yet the service levels from lenders and intermediaries, I'd like to think, were actually incredibly high, particularly if we remember the stresses of the stamp duty holiday in June. There weren't really that many issues. It went surprisingly smoothly for the amount of lending went through in a short period of time, and I think that's amazing. Following on from a couple of the things Phil and Tony said, completely agree on the face-to-face interaction from Phil. I've been going back in the office at least one day a week for a few months now, and it's just amazing. You just get a completely different kind of energy, don't you? And similarly, having lenders back in has been brilliant to see as well. I think remote works incredibly well, and we've done a great job of it, but there's just that extra couple of % from the face-to-face interaction when you're all back in the office. And similarly on the recruitment, we actually grow our own, so we bring in advisors through a training program, which helps us bring some kind of young energy and new people into the industry. And yeah, the fact the market was so positive that we could do that and grow as a business and bring some new people in was fantastic. But for me, the main positive from last year was the increased collaboration between intermediaries and lenders. When you think how busy it was, it could have been the opposite, but it wasn't. And what I'm noticing is a real pattern of lenders now coming to firms like myself and various others and actually going, look, we're thinking of doing this. Does it work? What's the detail? What should we look at? Help us shape things. Let's do a bit of a pilot. If we go back 3 or 4 years ago, lenders would often go through their various functions internally, land something, and you'd look at it and go, 20 other people do that, so I don't really see what the use is, and it was a little bit frustrating, and we've gone so far away from that now, it's unbelievable. And it's led to a world where, although rates are still very competitive, actually we've seen enhanced criteria, and in many instances better than it was pre-pandemic, which is absolutely incredible. And the other thing that we saw from that, which is real positive last year, just to end on, and this ties into what I think will happen this year, it was the first time in a few years we did a lot more lending to first-time buyers than to home movers, which I think is a real credit to what lenders have done in terms of high LTV lending, looking at additional incomes, and various other, obviously with the pandemic being off, there are a few different scenarios they need to look at, a bit of manual underwriting, and I think we'll see that continue this year. We're seeing a lot of demand from first-time buyers, and I think the increased collaboration between lenders and intermediaries will help us make that happen and have a nice positive year.
Brilliant. Tony, I'm going to come to you quickly on that because something Greg said really resonated with me, and I know it will with you, in this change in focus and this customer-centric focus, and really pushing that broker-lender relationship. It's something you've really focused on this year, and actually, you said bringing in talent. I mean, you've bolstered your team quicker than most years, I think, haven't you?
Yeah, Yeah, yeah. As I said, we've grown the team. You know, in 12 months we grew it. We added, well, went from 2.5 to 9 in the over the last year, and delighted to say got shameless plug now. I'm recruiting for 2 more right now. So if anybody's listening to this, then get in touch, please do. So no, look, we are very much that lender that isn't here to talk at you. It is to listen and talk with you. So what Greg said is absolutely spot on. We, you know, we don't have all the answers. We want to provide the solutions, but we don't necessarily have the answers straight away. So for us, it's about engaging, as Phil said, at events. That's brilliant, brilliant feedback for us, but also engaging with our partners and saying, what do you want from a product and a service perspective? We're here to make your life as easy as possible. So what do you need to do that? And wherever we can, we will do that. And that's what we've been doing. Well, it's what I've done throughout my career with intermediaries anyway, but here it's what we're doing right now. And, 2022 is all about that. How do we make it even easier to work with Saffron for intermediaries?
And Phil, just from a BDM to a broker, you've got Greg and yourself, you both work together, and Greg works with many other lenders. How have you seen this growth, this change that Greg discussed? Is it something you've felt and you've resonated with? Have you got stronger relationships with the brokers now? Did 2021 give that a bit of a kick up the bum, as it were, and the relationships are growing stronger?
Yeah, absolutely. I think one of the benefits of working from home and remotely was you're not out and about all the time traveling, so you have that bit more thinking time to do stuff and make sure and follow up actions and make sure stuff happens well as I think when sometimes you're in BAU mode, certainly pre-pandemic, you're just out and about from one appointment to the next, and I think it's helped. And if we can get the right balance now coming back, we're all the better for it.
Well, that's a positive chat about 2021, which makes everyone optimistic about 2022, I'm sure. Well, the news stories we're going to go through today are looking at some of the biggest stories that have hit us in the first 3 weeks of the year, 3 working weeks of the year. So we're going to start off with something that it's on Mortgage Solutions from Ordnance Survey. It's from Jim, their managing director, talking about postcodes. And actually, this is looking at a varying different elements around like risk assessments and land and postcodes, and it does affect our applicants. So just to summarize, like with you guys, I mean, it's saying here that with environmental impacts and the change and new locations, it's more now looking more than just postcodes. So we've got to start developing this. Tony, how you've read the story, what are your thoughts on what John had to say?
I think it's a really good story because it kind of shows you which can be often a feature of the mortgage industry, that it does lag a little bit behind in grasping things at times. Once it grasps it does it well, but we can be a little bit slow at times, particularly from a lender perspective. So I think what this kind of highlights is just the one bit there. The largest postcode in the UK covers 442 square kilometres. Now within that you've got quite a range of different properties, but if you look at a formulaic model, it will spit out the same answer because that's the postcode. So I think it's this is more impactful around the ancillaries around getting a mortgage, i.e. the insurances and probably the valuation being done and the resaleability based on a postcode, etc., etc. So I think it's a really good story, and I'm sure the others have got far more interesting things to say. But I think it does what it says. It highlights the fact that there are so many more data points that we could use to help educate future lending and future insurances or future whatever than we use at the moment. So it's a really good eye-opening story. But I will pass over to the others on this one.
Greg, I can see you're itching to talk about this one. I think you've got something to say on this one, so I'm going to come over to you first before we go to Phil.
Yeah, I'm just always intrigued with stories like this. For some reason, a cynical part of me always thinks about unintended consequences. And so I'm kind of just trying to work out what they want the future and conclusion to be. So the word is certainty in there. If the conclusion is maybe there should be instant certainty. So for example, a property would just be a straight decline to a lender because it's right on a floodplain next to a river. They just wouldn't lend. Great, saves everybody's time. If it's kind of hinting at individual risk assessments and pricing, well, lenders are constantly saying to me, margins are wafer thin at the moment. There's no room for negotiation. So if you're giving a client a lower rate based on a risk assessment based on the property and the location, that means somebody's getting a higher rate because you can't just offer lower if margins are wafer thin. And therefore, are you detrimenting a customer based on a property location of existing stock, which a lot of stock in the country is probably going to flag up as amber or red, particularly if you start going down the green agenda, EPC ratings, etc.
Yeah.
So there's definitely potential positives here, but it's one where I think there's so much detail that needs to unwind. But actually, we're at the very early stages of this discussion.
I agree. Phil, we had a brief discussion about this a little while ago. What are your thoughts on it?
Yeah, I just think technology is going to play a massive part in this and finding the solutions. So I think it's really important that lenders, brokers, etc. We all collaborate with the right partners to get the best outcomes.
I think
Tony, I think
point, Greg,
I know what you're going to say, but yeah, I was going to pass back to you. Carry on. Sorry.
well, no, I might surprise you. You never know. I was just going to go back to the point that Greg made. I think the most obvious application, which I hadn't thought of until Greg said it, is about this instant no. You know, in our world, lenders and intermediaries want a firm yes and a quick no. Yeah. So if you have a property that is dubious, but we wouldn't know until we've got a survey on it, then that's a longer no. Whereas if you can use this technology to go, actually, we'll build that into our modelling to say that we're just never going to do that. I think that's actually the application that works. And I think that's
just to touch on that, because we've had this conversation loads of times. Technology, we've said it a lot. We're still falling a bit behind, aren't we? There's huge strides that need to be done in the industry with regards to tech to make it fairer.
Yeah, and technology isn't because we're an industry of Luddites that don't want to change. There might be a few, but it is a lot of it's around infrastructure and legacy systems. The cost of changing is absolutely frightening, and that's the biggest issue with our industry, is that a lot of lenders are on old tech that actually to bring it up to speed is a big cost and a big undertaking. So it's not through a want, it's just through actual capability and capacity to do it. But we'll get there.
If I could just step in there quickly, Jay.
Go on, Greg.
Yeah, because don't worry, I won't just start talking a lot about technology in the industry, or we'll finish the webinar, because that could be an hour at least. But the only thing I was going to ask, Tony's spot on, but there are some small wins, and actually the last 12 months has been a huge improvement, so we're getting there. But there are some instances where the various stakeholders in the kind of house purchase journey, if we just collaborated that little bit more, I think there are some small wins. The obvious one for me is we're just implementing EID. And what's really interesting is it's a provider that lenders will use and accept, but then you've got solicitors and you've got estate agents, but we can't accept each other's. There's not one universal truth. So you could have a client having an EID check by us, the lender, the estate agent, and the solicitor. It could be by the same company, but it still has to happen 4 times because we can't use each other's. And it's just small things like that which have improved. But I think if you were somebody from another industry and you heard that and looked at it, you'd think that was bonkers. So there are some small wins. Hopefully, we can make progress on in the next couple of years.
I wrote just completely away from this. I mean, I am independent, but I wrote an article. I wrote a 5,000 word article on EID and on platforms. And it's everybody's using the same provider, but nobody can actually use the same data. It's just not, the system's not there yet. But it is there. It's a very simple thing to fix. But there's a lovely word you used in there, Greg, and I think we take away this for 2022 is collaboration. We've mentioned it twice in two different topics so far. It's all about collaboration. I think as long as the industry keeps doing that, this growth and change and development that we're seeing is just going to be enhanced and improved, surely. Right. Shall we move on? Let's move on to this is on Specialist Finance Introducer. Our second story comes from Roxana, and it's that specialist lenders can play a key role in the transition to a greener economy. So they want to push all the blame for the greener economy onto specialist lenders. No, that's not the case. This is very much talking about the next decade being really crucial to the planet, the environment. We've had COP26. It feels like it was about 5 years ago, but we've had COP26. People are starting to think about it. There's green mortgages and other green finance out there. Is it really down to specialist lenders, Tony? You fall under that category. Is it really down to us? And what's being done? Is enough being done?
Well, I think specialist lenders are a natural start point because we will take those slightly perceived riskier decisions earlier on and therefore can drive through. But, so it probably is the vanguard because there's a lot of stuff that specialist lenders did 2-3 years ago that the high street now just do as standard. So we proved it, paved the way for it, and now others are doing it, sadly, at a lower margin than we are. So, but that's the price you pay. So, in this environment, though, I think, but this is very much about lending and the surveying industry working together, because that's where this comes undone. So, we Saffron, we're well known for our flexibility on modern methods of construction, and we will consider a lot of these things provided they have the relevant accreditation. But where we fall down is when a surveyor looks at it and won't give us the value or can't. And that's because a lot of this stuff is still new, and therefore there's not enough existing stock in order to provide a confidence rating and for them to stick their neck above the block and give it a value. It is changing, but I think that's the biggest challenge we've got with this going forward. So 100%, and I'm looking at this article, and this article is very much focused around the development side rather than the lending to the end user. This is about the person building it. Mm-hmm. But it's the same thing. It's the same. End of the day, someone's got to value it. Who's got to go, that's okay. That's safe for you to lend that money on. And I think we're moving on that, but there is still some way to go. I mean, I'll be interested in Greg's view from the customer or perspective, really.
Greg, I'll let you pick up from there. Actually,
Yeah, it's a really interesting point because a lot of our lender meetings now, the green agenda comes up. It's been really at the top of the kind of agenda for the lenders. As myself at an RMD chat sometimes, we don't have customers asking about it. And I think part of that could be we're in London and the South East, so most of the stock is kind of horrendous EPC ratings, but they're the ones that are near the schools or have the gardens, and they're the nice Victorian house that they like. But the other point in relation to the article, I agree, specialist lenders of course have a really important role to play here. A lot of development, commercial, self-build is done in the specialist market, but in reality this is such a big topic where you've got 75% of lending done amongst 6 lenders, 90% done amongst 15. The specialist market can only do so much. So in my personal opinion, actually, if this really is going to change in the way that kind of people are discussing as a whole change in society and the industry, for me, it's actually more the big high street lenders who would need to lead, because that's the only way it's going to be big enough and have the volume to change the market.
Yeah, that's a good point.
In reality, though, that's a really strong point.
Going to be regulated, yeah.
Do you think, in honesty, Tony, you tapped on this, and Greg, you'll know more, and you definitely just comment on this. Do potential applicants actually care? Do first-time buyers really care? Is it high on the actual buyer's agenda, or do they think there's bigger things and bigger issues to worry about? I mean, I'm getting your guys' opinion. I don't know. This is just to get your thoughts on it. Phil, I'll come to you first. Do you think they care?
I think they will care as as energy bills go up and increase, and we start to see it I think it'll be a bit of stick and carrot approach by. So I think it, yeah. Sorry, I lost words there a bit, but yeah.
Tony, I'll come over to Tony
Yeah,
while
threaded
Phil
this bit
gives his
out,
thoughts.
yeah.
But Tony, what
Yeah.
do you think? I mean, you're on the front end. I'm not. I'm looking at it from an external perspective, and I'm thinking, I care. I've changed my energy supplier to 100% green energy because I care. Likewise, I'm also watching my smart meter telling me I'm spending 15 pence a second sometimes, and you think, actually, it's impacting us in that way. But you know, in reality, are you seeing that from applicants?
Not it's moving, but it's not. It's all about what's in it for me, right? And it's for all of us. And if you don't, and green is a thing that everybody talks about, and it's nice, and they can look at the tangibles like I recycle and I do this and do that. But when it comes to a house and that stuff, it's not clear enough yet. And there's no until that trigger between doing something and a financial impact, in my view, you won't see this massive change. And I think Phil's knocked it on the head there in terms of it's going to force the behaviour now because the cost of fuel and the cost of everything's going up. One of our later topics is about the cost of making affordability and ensuring that the right assessments in place. So I think it will start to come more into the consciousness, but you've got to drive the what's in it for me factor for us as humans. So if I want to invest in a heat pump, what am I going to get as a result? What benefit am I getting? Because all I can see is an outlay. If I'm investing in this, so from a lender perspective, or from a supplier of these of green technologies, make it worth our while. Make it obvious as to why I'm doing this. Yeah, we all want to save the environment, but there's a cost, and there's that balancing seesaw point between cost and I feel better about myself. So I think we've got some work to do there, and as I said, it's only green has only really burst into the scene in the mortgage world in the last 6 months, really. I'm going to shamelessly plug now. We've had a green mortgage product, our retrofit product, for 2 years, and I'll be honest, we've sold very little because no one was interested. However, now, because it's doing what it should be done all along, which is supporting those with older housing stock to develop their EPC rating only to a minimum of E. So we're not saying you've got to be super efficient, and then we'll give you a 10 basis points reduction in your interest rate. So it's starting to pick up, and we're starting to get people talking about it. But for the last 2 years, it's done nothing because so what? So I think it's that financial bit that's got to happen first.
I think also from an external perspective, again, looking in, it's the same with all these green products that are coming out. It's the difference between what is actually an environmentally impactful product and what is greenwashing. We've all heard what greenwashing is. And I've looked at some things that I've seen come through. I've seen bank accounts, all sorts of things come out from various different financial organizations. And when you delve deep, there's nothing that will affect the environment in any impactful way for an individual. So it's again weeding that out. It's nice to hear the retrofit, Tony, because the biggest issue we have in this country is our housing stock.
Yeah.
Our old housing stock is not efficient. So that leads on beautifully, actually. Sorry, Phil, carry on.
So I was just saying, you've seen a lot of lenders using offsetting as their green solution, and I'd ask the question: is that really green? Is it the right thing to do, or are they just passing the buck?
The problem we have,
I'm not sure. I don't know.
Greg, I don't know if you agree with me, but I think there's so much pressure on businesses to show their ESG credentials, show that they are doing what they should be doing. And actually, some of these people, which does make me laugh, some of these people will judge a company because their ESG policies aren't great. So I'm not going to borrow from them. I'm not going to borrow from them. I'm not going to do that with them. But actually, they wouldn't choose a product. But Greg, do you think it is the fact that lenders are feeling the need to add green products because people are looking at them from the outside, or do they actually have that stronger green credentials? And is it rife across the industry, or is it thinned out?
I think it's a combination of both, because actually I have to say most of my lender meetings on the topic, there's been genuine passion and desire for change. So that does come across. The problem is it's a very, very complex question and it doesn't have an easy answer. So I think the initial green mortgages we've seen to do with EPC ratings it's good, it's positive, it's a lower rate for the right properties, but that's not a solution. That's just rewarding stock that's already at that rating, mainly new build. So it doesn't really change anything. So that is a little bit more marketing, in my opinion, but at least showing you're doing something. I prefer the ideas Tony's had. If somebody should, because Jay, something you said really stands out to me, and this is what we see. Home movers do not ask this question. They just look at the stock, they get blinded, and they'll believe they can just change it later. Remortgage customers, this is really high on the agenda because people do have a desire. It is big in society. People do want to change their property. Something more innovative where there could be almost interest-free lending or half the rate, based on retrofitting your property. That would be something really interesting. But in my humble opinion, if the solution is always going to be the rates 0.05 lower, it's a cherry on top of a cake, but you have to decide you want the cake already to have that. It's not actually going to change anything. So, yeah, I think lenders do have a desire, but I think it's a complex question, and there's a lot further we all need to go on this.
Cool.
I don't think any of us have a clear view, do we, Tony? I mean, nobody has a clear direction because there's from the top.
All I can say is, 2022 is going to be a big year for green in the mortgage industry. L&G recently confirmed that over 63% of their lender base has a green agenda. Some doing it already, some liking to do it, some wanting to do it. So there's various stages, but it's, a big swathe of the lending market is now going, right, how do we start to solve this issue? So it's going to take time. And as you say, I completely agree with what Greg said, that, our retrofit is a sticking plaster for the problem. It's not solving the problem. It's just stopping it getting worse. So I accept that. And actually, after this, we will meet with Greg to get his ideas on those products, because if we can do something about it, we will. So we'll get you, Phil and I will grab you and get your thoughts on it, Greg, please, because that's really useful for us. Because it's a massive, as a business, it's not just about our mortgages, it's about us as a building society and our whole CSR agenda. In fact, I've had the debate today about company cars and the fact that should we now go full electric for company cars? Can we manage that? At the very least, we should be at hybrids, so no more petrol or diesel cars. So we're really on that agenda, and all our facilities vans are electric. So we are really driving that agenda. So naturally, it will spill over into how we lend money eventually.
There's a really, really good point to there. Thanks, guys. And it leads us very beautifully, and Tony's already plugged it, to our next story, which is talking about the cost of living crisis. Obviously, to anyone listening, if you improve your EPC rating of your house, your bills go down. As I noticed when I added extra insulation to my loft, all of a sudden I was like, this is making a difference. And it's the small things you can do. But energy prices are soaring. We're all going to get whacked with the new national insurance increase of quite a lot of base points. So if you look, it's quite an increase in national insurance payments next year. People are really on the breadline, and it is going to affect borrowers in 2022. We can't predict what the government are going to do. They might U-turn on this national insurance thing. It's very, very likely. But then the pessimist in me says probably not likely at all. So we have got this looming. How can we manage this? I mean, we're discussing here, we're talking here about people borrowing money for houses. The cost of living, renting's almost going to be impossible for some of these people. Saving for a mortgage deposit, next to nearly impossible. People are going into this vicious cycle. What's it going to mean? And who's going to be hit the most? Phil, I'll come to you first. Who do you think? What's your opinion on this story, and where you think this year's going to go?
Yeah, I think, for existing homeowners, I think the first point is, if you're a homeowner, you've got a mortgage, go and see a really good mortgage broker and get advice, and make sure you're getting the best deal you possibly can, because if you can reduce your mortgage payments, then that will help offset your your bills going up. So I think it's consumers getting the advice. I think the other part, in terms of helping first-time buyers onto the ladder out of renting, I still think the bank of mum and dad will continue to be a bigger and bigger part of it, whether that's parents helping with deposits or helping with the payments. We're going to see more joint borrower sole proprietor solutions, and not just for first time buyers. I think we'll see it for second time buyers as well. So and will we see intergenerational mortgages, things like that? I don't know, but those are my initial thoughts on it. But it's all about everybody finding as many ways as possible to keep control of what costs they can do. And reviewing your mortgage is a great option.
Before I go to Tony Gregg, I want to come to you from a broker's perspective, because Phil nicely tuned you up there. Just come to you on your opinion on it. You look like you're about to brace to say something, so yeah, go ahead.
I think I always look like that, don't I? Yeah, that was a great plug, Phil. Thank you, and completely agree. Yeah, I mean, twofold of this. First of all, it will impact affordability, but it should do. Lenders have to do an affordability assessment. It works primarily off a client's net income and obviously estimated costs. And for me, since MMR's came in and done that, it's a great thing, because you go to bed at night every day knowing that despite some sensationalist articles every now and again, we've got a very robust mortgage market, because everything's stress tested to high heaven on affordability. The flip side to me, though, and the point you made, Jay, about rent payments really stands out, because what really, really frustrates me every year is we sit down with clients who spend £1,200 a month on rent 5 years in a row, and we tell them they can't afford an £800 a month mortgage, and it really confuses them. And a big part of that, of course, is this regulatory stress test, SVR plus 3%. And that's, of course, being looked at, which has been confirmed by the Bank of England. That could balance this out.
Yeah.
Because at the moment, if a client's having their mortgage stressed at 8%, then anything here is going to make it harder, and they're going to be offered less borrowing. But if we have genuine innovation and change on that side of things, and because I think even though interest rates are set to rise, and they will rise this year, we're talking about getting back to the 1-2%. So we're not talking about 5-6%. So we don't need to stress people at 7-8%. They should be stressed at 4-5%. And that could make a huge difference and balance out the affordability issues here. And the only last thing I thought I'd add, because I completely agree with Phil, joint borrower sole proprietor is brilliant. The more marketing and promotion of that in the industry, the better. Lenders like Saffron do a great job on that kind of thing, and long may it continue. And also, I think as Help to Buy comes to an end, which I think will be a bigger news story in a few months as people realise it's around the corner. We're in discussions with a lot of small private firms looking to kind of private Help to Buy, private shared equity, private shared ownership. And again, I know lenders like Saffron are talking to these people as well. But they're things that genuinely help with affordability and low deposits, and again, intergenerational lending. So it could be a really interesting year for first-time buyers. But I think in terms of this specific story and the rise of living costs, a lot of it rests on that piece of regulation. And if that changes, hopefully that will balance out any negative we'll see in the market.
Yeah. The other key thing I would say is, whilst affordability is driven by regulatory approach, every single lender's model is different, because our regulatory approach to life is about principles, not structured. So it's down to your own risk. So again, back to Phil's point about go and see a quality broker, because the variance in affordability between lenders is huge. I mean, we're talking, in certain examples, tens of thousands of pounds based on that lender's affordability model. So that's what I would, and there's great tools out there for brokers which they use now, which allow them to look at affordability at the start point of the journey. So who can lend them the money they want, and then you look at the criteria, then you look at what's the right product for them. So I think that makes a big difference, and it is quite frightening when you see the variance in affordability. I think going forwards, there will be some tweaks to models. A lot of lenders use the Office of National Statistics ONS data. So as that data updates this year with rising utility costs, rising food costs, rising everything costs, you will see a slight squeeze on affordability. But as Greg says, if and when the common sense prevails and we come off an 8% stress rate, it will balance that out. But yeah, I think it's about go and find a decent broker that knows what they're talking about, because there's such a variance in affordability.
Just to give some advice to those that might be listening that aren't necessarily a broker or in our industry. They might have just stumbled across the podcast. So I just want to just cover this. If you are finding yourself in a particularly difficult situation, you have, Tony, I'm going to come to you. You have a mortgage with Saffron. You're in a really dire situation. The really important thing here is communication, isn't it? Actually speaking to your lender and having that
Yeah.
conversation, because I think people are genuinely really worried.
Yeah, absolutely. The first thing to do if you're struggling or concerned about paying it is tell us, because at least then we're aware of it, and we can then look at what are all the options available for you. And there are always options, and you're not in this alone. We throughout the pandemic, our arrears team have helped an awful amount of people with wanting the payment holidays and etc. etc. So you're right, Jay. First thing is ring your lender. Don't don't do the ostrich. Ring your lender.
It's very easy to do it, isn't it? I think we've all been in a situation in our lives
Yeah.
at some point, whether we're right back when we're students or even as adult life, when your family and kids.
Yeah.
There's sometimes in your life where you stress and you worry about money,
100%.
and it's quite easy to stick your head firmly in the sand and hide away from it. So let's not dwell on that too much. But if anybody is concerned, we do actually have some tips and advice on that on previous webinars and podcasts. So just search for SFI Live, have a look back. You'll find some interesting bits on there. We've talked about this before. Okay, we're going to move on to our next story. This comes from FT Advisor, one of my favourite reads of the day. Always catch up on this. And this is talking about financial wellbeing and fintech. Now, financial technology, we're not, nobody's not heard of it. I've got a bank account that is 100% digital. But this is much more talking about how it can be a driving force for good, and these fintech coming in. But Tony, I thought this is a good chance for us to talk about technology again. I know we briefly talked about it a while ago, but technologies can be a really good solution, can't it, for all of us? But it can also be a holdback. Just relying 100% on technology as we stand at the moment isn't necessarily in the borrower's market, is it? It can be quite, what's the word I'm looking for? It can be quite restrictive.
Fintech from a mortgage perspective will massively and is hugely helping the journey. We are, as a country, very slow on our whole mortgage purchase of a house process, and not just the lender, but more the solicitors and everything else. I think we've said before that in the Scandinavian countries all this can happen in 10 minutes and it takes us a month. So we've got some way to go. I think from our perspective as a specialist lender, we use technology, and we're developing our capability for technology to get those cases to our underwriters as quickly as possible, with enough information first time that allows them to make a decision. So I can't wait until we can fully use open banking and not have to ask for paperwork anymore, because it's just an obvious thing. And we know lenders in the big six and high street are starting to use that technology already because they've got it. So I think that's where again we want to be. It's all about making it as easy as possible for a mortgage intermediary to use us to help their clients. So, but we do have a lot to learn from other industries still, even in financial services and particularly like personal loans and things like that, where it's instant. It's instant. You get an instant decision, and then you don't have to sign anything because it's just all done. Whereas we're still, you got to get your ink out and sign a bit of paper.
Is that necessarily the fairest though, Tony? Bearing in mind that some of the content of this article was about people's financial health, and there's a really strong point here talking about credit checking, that somebody with limited credit but a pretty good income and limited credit, their credit rating can actually be impacted by that. So actually a digital solution takes away a little bit of the kind of personal hands-on approach to lending, doesn't it?
Yeah, but that's the perennial problem, and it touches on the thing that Greg said about the renter trying to buy a house. You've got evidence of someone never needing credit, which should be a brilliant thing, but actually it's a detrimental characteristic. I remember I've got friends who are multi-millionaires that went into a House of Fraser store, were asked for a card because they could get money off, and they're like, "I'll go on then," and they got declined it because they'd never had credit because they don't need it. They're absolutely minted. So that's the mockery of these situations. So I agree with that. You're penalised for being a good citizen and never needing
That's
credit.
where manual underwriting can come in as
Great.
well. So, it's having that balance, isn't it?
True.
There's room for technology, and as Tony says, innovation comes from fintech and new lenders, and the industry needs innovation. So we should embrace it. But at the same time, there's still room for a manual underwriting approach for those clients who need the human touch. So there's room for both.
Well, I think also in talking about tech, AI, artificial intelligence, is growing at such a level that it can sort of emulate human response now. So in time, I'm not saying it's going to happen in the next decade, but AI could be the future. But Greg, how have you seen you've been around 15 years, have you seen this change and the technology change? Do you think the future's looking brighter with fintech?
Last 18 months has reassured me, because there was a period before then which really worried me, where we'd meet a lot of fintech firms who'd invented a solution, but there wasn't really a problem, so they tried to create a problem. And then they would say they were a business in their own right, but actually it would just be a tiny add-on to the process, but they try and charge large sums of money, got lots of funding, called themselves unicorns. And then going back to Tony and Phil's points, which were all music to my ears, you've then in the intermediary space got some new entrants to the market who wanted to digitize the whole end-to-end process. And luckily, they don't brand themselves that way. They've kind of pivoted these firms very quickly, because the reality is the mortgage market is so complex and there are so many options for every client scenario. You can't digitize the entire process. What you should be looking for is improving productivity and improving the customer journey. Make life easier for everybody in the chain. And I feel that's now where we're getting to. But then there's always going to be 10 to 20% of customers who need that extra set of eyes, which is where the manual underwriting comes in. Lenders like Saffron are worth their weight in gold. Let's go to your scenario, Jay. If we were in an entirely fintech world, that client with the low credit score wouldn't be able to get a very good mortgage rate or a mortgage at all. Whereas in reality, the world we're in, if it doesn't quite go through the system at first touch, as an intermediary, we know we've got 20, 30 lenders we can pick up the phone to and go, look at this great customer I've got for you. I just need you to have a human look at things here. And vice versa, we see the same from customers as well, interestingly. I think we should always remember a mortgage is very different to a credit card or a car loan. It's only done once every few years, and it's the largest single financial transaction in most people's lives. If it's not, you're lucky and probably very wealthy, so it's less relevant. But we find even now, even the most switched on, savvy, high income first time buyers or home movers, they want to sit down with us for an hour and go through everything, because it is very complex. There's lots to it, and you just want that reassurance. So I think we're going in the right direction. I think it's going to get better and better the next couple of years. But I think we've all now cottoned on. It's about making us all more productive, making it easier for the customer, and improving the journey for everybody, not completely changing. Evolution, not revolution, in my personal humble opinion.
100%.
Tony, just to pick up with you, we work on another version of SFI, SFI Live, the webinars, and we teach a lot of people, we teach a lot of brokers, we educate brokers on changes and things that are happening and better ways of processing. Is it really now the lenders that have got to push that knowledge out a little bit to the borrowers themselves? Because I'm not in the industry, I'm independent, so I've learned a lot about what is on your credit file, how to look after it, and all of a sudden I'm going through my credit file going, that shouldn't be on there, what's that, what's this, and my ratings dramatically improved. I would never have done that had I have known the impact of such small things on my credit file. So we're doing this education. Do you think the next step is to really push that education? Martin Lewis does it brilliantly. Various other people does it brilliantly, but to a smaller audience. Is it up to the lenders to almost educate the consumer as well?
Well, I think definitely, and educate brokers as well, because a lot of the issues we find is where a broker's not read a credit file properly. And we have to kind of say, you might want to have another look at this one, and you'll understand why we're perhaps saying no to you. So, yes, education is a big topic for us, and I agree that the consumer needs educating, but I'll take it back a step further. This has to be curriculum for schools. we just and I know it's a banging an old drum, but this is where it starts. The financial literacy in the UK is very, very poor. Start it at bloody school. Drop some of the other stuff that's maybe not relevant anymore and start teaching people how to manage money and understand the impact that money has on their lives and what they can do about it. So I agree, we can do more, and we're constantly looking at how do we educate our brokers and how can we help and support and make it easier for them to help, their clients. But yeah, I think there's a wider agenda with all this as well.
Phil,
No,
you look like
no,
you're
that
poised
was-
to say
yeah,
something.
I
Have you got a
just
comment
agreed
on
with
that?
Tony. Yeah.
Are you just interested in the conversation? And I think, as somebody who, I don't have a mortgage, my house is paid off, so I don't have a mortgage. My credit rating per se should be really, really good, but I don't borrow. So again, I've had the same problem. And actually, I went to go get car finance and couldn't get it because it was all automated, and they was throwing out. And I was sitting thinking, well, I've a decent salary, I'm not in debt. Why am I a problem to you? And they were throwing out bad credit finance companies to me, and I'm thinking, why would I want that? There's nothing wrong with my credit rating, and it was just because it was automated, and I don't have any recent transactions, and I didn't understand this. So lots of education, and look out for us because we have got some. I'm my blatant plug this time. We have got some both consumer and broker education coming out on this in the next few months. So watch this space. I'm going to move on really quickly because we are going to go way beyond our hour if we're not careful. But I really do want to cover. Very quickly on this holiday let, because Tony, you and I have had a conversation about this massive growth in the holiday let market. Greg, how big is it? Because I've seen loads and loads of articles about this. This one's on Money Facts. Is it a growing market? Are you getting lots of inquiries as brokers? Are there people coming out of the woodwork that are now thinking, this is where I want to be?
Oh, absolutely. It seems to be the thing where people now are planning to move to the Yorkshire or Devon or Cornwall in 10, 15 years. So they want to buy the holiday investment beforehand. And it's really funny because about 18 months ago, myself and two peers, two other firms, got together and had a meeting about how we need to speak to lenders about holiday lets because there aren't enough options or products. And then you see this article, lenders were one step ahead of us. It's now really, really well served. And I see it continuing to grow. We're also seeing landlords looking to diversify. So whereas before they would just buy your bog standard flats and let them out on an AST basis, I think they're now looking at their 1% yields and then looking what they paid for their holiday cottage in Dorset last year and going, hang on a minute, that looks quite interesting, that's quite juicy, why aren't I investing in that kind of stock instead? So yeah, the lending market has definitely got better, but spot on, the demand is there, 100%. We've seen big growth.
I have to admit, for the benefit of the listeners, I'm based in Norfolk. I'm right near the coast, so my sister lives in Heacham, a small little village on the coast. And the majority of the houses around her, due to the nature of her being so close to the beach, she's probably one of the only residents. She spends the whole year saying hello to different people all through the year, and that literally, in the last 2 years, has been evident as the stamp duty holiday. So, Tony, we're not in this area. Is it something that you've considered at Saffron?
Yeah, it's not through want of not trying to be in it. It's just timing for us. Quite frankly, we pull back on our buy to let in general because there are limits you can have as a lender within this space, and we are, because of our success in other areas of buy to let, and this is a feature of it, we are limited to what we can do. But we do plan to enter this, and we also are looking at broadening our holiday home product as well. So not just, we already allow borrowers to buy a second home up to 80% as a resi property, but we don't currently allow things like Airbnb or short-term let. And that's an area of our policy that we're looking at the moment to enable those who've got a home that want to earn some cash from it to do so legally. So I'm sure a load do it illegally at the moment. Because it's not something you'd think about from a lender contract perspective.
I wouldn't have known any different.
No,
if I'm honest, last week that conversation wouldn't have known any different.
But yeah, so it is an area we want to be in. It's just it's timing for us. So I expect us to be in this area at some point later this year. I suppose I'm pleased to hear from Greg that the market's still there and still growing, because my concern was that I've missed the opportunity as we now see a shift back towards getting on the plane to Benidorm because that side of the pandemic seems to be waning down a little bit. So, but it's good to hear that it's still a quality market, and it's good to hear that, as you say, portfolio landlords are looking to diversify and spread their portfolio across both sectors. So that's good to hear.
I'm going to Phil have a voice on this one. She just said portfolio landlords. Phil, we introduced, or you introduced, I say we, the royal we, limited company buy-to-let mortgages last year. You evidently saw, I mean, the stamp duty holiday probably gave us a bit of a buoyancy that we didn't expect, but buy-to-let is still in a massive growth,
Yeah,
isn't it, Phil? You get a lot of inquiries from brokers?
Right across the spectrum. We're still seeing a lot of expat inquiries, so UK expats who are living and working abroad, they still seeing value in UK property, whether they want to retain a foothold in the UK market or have something to eventually return to. That's not slowed down at all. Product was really successful last year. I think as lending to first time buyer, first time landlord helps as well. And yeah, we lend to portfolio landlords without no limits outside what they lend with us. So all of those areas are consistently remain strong.
Yeah,
that's a strong message, actually, Tony. I want to come to you on that. The first time buyer, first time landlord. That was quite interesting for me to grasp. Just explain that a little bit.
well, as it says, we are quite comfortable with somebody that hasn't owned a residential property or had an investment property before. We are very happy to consider them. And for a lot of young people who can't necessarily afford a residential property because of affordability challenges and stress rates, etc., but actually can afford the rules around an investment and want to get their foot on the mortgage ladder, then it's a perfectly it's a great opportunity, and we do it across the piece. So all of our buy-to-let product range allows first-time buyer, first-time landlord, and actually we're seeing those numbers, particularly on the expat side, picking up quite a bit at the moment.
That's really good to hear. Really good to hear. Brilliant. I'm going to skip very quickly because we're running out of time, but very quickly to our last story. Just sorry, Tony, what were you saying?
I was just wanting to understand from that first-time buyer, first-time landlord, from Greg's perspective, really, as a as a broker in the market with his company.
I think it is largest in the expat space, which I heard you reference, because obviously they typically don't own in the UK. A lot of them have built up some good savings, hence moving overseas and want to invest back here. So that's a big market. Onshore, less so. Most landlords tend to own their main residence, we find. You do see some where people, for affordability reasons, just invest where they're from. So in other parts of the country, property prices are lower. But for us, I'd say the expat market is bigger in first-time buyer, first-time landlord, which is a great product.
I have to admit, even 15, 20 years ago, when I moved to London, there was a group of us, actually. We all worked in London. We all came from Norfolk. The majority of the group bought a 1 or 2 bedroom house. Some bought a 3 or 4 bedroom house because of affordability, because they could afford to buy and rent, because they were living in London. And, my rent alone in my apartment was £2,400 a month for a 2 bedroom apartment in London. I needed to be able to afford that, and so buying a property in London was not an option, obviously. So you can imagine, for my group of friends, all of us went to university, come back to Norfolk and said, right, we're going on our career ladder. We all went to London. They were all sensible, and once they got to the stage of meeting a partner, having children, they're now living back in Norfolk again. We're all back together. But yeah, sometimes it's the only option, I guess. Yeah. Right, shipping straight on to our last topic of today's podcast, and that is this 24% increase in equity release. Now, Tony, I've put this in for a reason. Q and I have been having a conversation about later-life lending and the changes in later-life lending. There's several reasons for this. We're an aging society. Things are changing. Our lifestyles are changing. We're working later. For financial reasons more than anything else. We might have to work into our 70s by the time us guys get there. This is not really a surprise, is it? But is it the only option?
Well, I think what this article kind of highlights is the development in the actual equity release market in the product set, in terms of there's very little distinction now between a residential later life mortgage and an equity release solution, which for the consumer is brilliant, because it's funny. I was having my haircut the other day, and the guy was an alarm engineer, so I was asking him about alarms, and then he started asking me about mortgages. And he said, "I'm in my 50s, I'll never get a mortgage again, will I?" And I said, "No, of course you can. You can get one easily. There's a whole raft of solutions. Don't ever think you can't." So I think this article proves that whatever the scenario you face, when you're over 50, there is an affordable option for you, and whether you want to pay interest, don't want to pay interest, want to downsize or what, the options are there. And as you said, it's a growing problem. We still know that there's 30,000 interest-only mortgages maturing every year between now and 2030 that have no repayment vehicle. So this is not a blip. This is a continued upwards trend. And again, it's that education. People who are worried need to go and find a quality mortgage advisor that will go through all the options available, from a residential RIO or over 55s kind of product, or downsize, or actually is equity release, because you can't afford payments, a better option for you. So I think it's just I suppose it's, as someone who's now over 50, it's never been a better time to be over 50 in the mortgage market, because the options for you are huge. I think that's what I would say.
Greg, just coming to you from a broker's perspective. Obviously, you've got insight into the lenders, the borrowers that are coming to you, and the lenders. What's your opinion on it? Are you seeing this increase? And as Tony said, with these mortgages maturing.
Yeah, definitely a growing market. We're seeing mainly two reasons. So one is, as Phil mentioned earlier, intergenerational lending. So grandparents with lots of equity kind of going, why am I sitting on this when my grandkids can't get on the ladder and they're moaning about deposit? Let's release that. And the other we're seeing a big increase of are people who are reaching the end of their interest-only mortgage. And they're kind of going, oh, my plan was to downsize. And they're going, hang on, I don't feel old at all. This is a family home. Why was I downsizing? But when they were 45, 70 sounded really old. And then they're getting 70 and it's not. The only other thing I thought I'd mention, though, because this article is very related to equity release, and Tony's right that the pricing's got a lot better, but my concern still on this part of the market is there's later life, there's RIO, there's equity release. The best option can be very different based on the client scenario, and we just need to make sure every client is getting holistic advice into all three areas so they can make the correct decision.
Yeah.
There's some really good later life options now. There are some building societies who have unlimited max ages, some RIO rates are great and go to really high affordability, maximum borrowing, and then some equity release mortgages are fantastic, and in fact for a lot of borrowers they may be the only option. That's the only thing I thought I'd add. I always think it's a bit odd when there's an article which just focuses on one of the three, because I think everything should always focus on the advice piece of all three being options.
Yeah,
I'd love to have seen this run side by side with the increase in RIO and things like that as well, because it'd been interesting to see what's going on there. Phil, do you have any comments on this? Because obviously you're dealing with brokers directly, Greg being one of them, but obviously and other companies. This is obviously a future market that's going to be ever evolving, I suppose, as we adjust I
still think we're at the beginning of the journey on this. So I'm hoping this is an area where we will see more innovation. RIO was great and it had the right intentions, but it's still flawed for joint borrowing. So I think that needs looking at, and as lenders we need some support from the regulator on that to make it easy for us. But as Greg and Tony said, there's a lot of other specialist lender products out there for later life solutions where you can lend into the early 90s or beyond. So I mean, from a Saffron point of view, most RIO inquiries turn into a later life lending downsizing conversation ultimately, which can sometimes be a better solution. So that goes back to the point again about clients getting the right advice. So it's all down to advice as far as I'm concerned. That's what's paramount, and not just being pigeonholed into one area.
I'm gonna blatantly plug before I pull over to you, Tony, in that we are doing a webinar on later life lending. We will be covering all of this topic with Holly Andrews for the last time in 2020. We'll have Holly Andrews and Tony. We're going to be talking about later life lending. It's on the 9th of February. Registrations are now open. So if you go to the Saffron for Intermediaries social channels, you'll find the link on there to sign up, get yourself on. It's an hour. There's going to be a very open discussion about later life lending. So that's the chance for brokers to really get educated from us as a lender side, so that you can give the best advice. So Tony, just going over to you to finish off conversations on this later life lending. What's your thoughts?
Yeah, I think, Phil and Greg have said it all. This is all about getting the right advice and getting a holistic picture. As you know, there is some binary solutions that look obvious, but you've got to tie the three together. And the three actually work together in a cycle, because as Greg just said, someone who's doing a downsizing product, which sounds great at the time, when you get there, you go, actually, I don't want to. But I want to stay here, but I need to pay this loan off. So equity release then becomes a solution to that. So it's a cycle. So I think the thing is about get the advice, and as my advice to brokers would be, don't shy away from this. This is a growing market. As other areas of the market are shrinking, this is a huge opportunity for you to support more clients. So seek help with it, seek advice. And
give you a chance of a blatant plug, Tony.
Opportunities to this.
Give you a chance of a blatant plug, Tony, then. So are Saffron looking at their later life options? Obviously, there are options available through Saffron. Is that something you're reviewing?
Well, yeah, I mean, as Phil said, we're already in the Rio space. We are looking at how can we make that Rio a bit more available. So we're looking at our criteria around that. We're already doing the lending into downsizing product, and we're looking at a few of our criteria points that, again, would make that more accessible. We already have a no maximum age policy. So it's based on, we'll lend you up to, it's an Office of National Statistics mortality table. So we'll plug your age in, and potentially we could do a 5-year term for a 90-year-old if that was the appropriate thing to do. So we have that, and we also allow earned income at the moment up to age 75. So, lots of opportunities for people who are looking for later life solutions that are available from us and others like us.
Wonderful. Well, guys, we've got time up. So that's it for this month's SFI Not So Live. I hope you guys enjoyed it. Who's listening? Don't forget to sign up to the series, because it'll let you know when the next one goes up in March. But for now, I just want to say thank you to Tony and Phil. Thank you, guys. We'll see you again next month. Greg, thank you very much for joining us. It's been absolutely brilliant to have you on.
Sure, thank you.
Thanks, Greg.
And for those stuff. Well, just another plug for that. SFI Live is the 9th of February, 11 a.m. Registrations are now open. It's a completely free webinar. You do get provided CPD certificates at the end, and it's fully interactive. So we can answer questions, obviously keep data back, but we can answer questions on actual cases, but we are focusing on later life lending. So we will discuss things that even Saffron don't offer, but try and give you as much information, advice, guidance that we can give you for those clients that approach you for those mortgages. So that's on the 9th of February. We're back again with SFI Not So Live in March. I've been Jay Evans. This is SFI Not So Live. Thank you very much, and good night.